I'm Osborne Foreman, and this week I'm going to show you the UK stocks I bought, the top riser and faller in the portfolio, as well as the share tip of the week, or my thoughts on GameStop. And if you find the video useful or entertaining, please drop one of these to support the channel. According to Google Finance, the FTSE 100 is down by 4.26%. The S&P 500 is down by 3.61%, and the FTSE 250 is down by 1.78%. My portfolio is only down by 0.87%, meaning that I significantly outperformed the FTSE 100 and S&P 500, but not by that much of a margin to the FTSE 250. However, when we look at the grand scheme of things, ultimately I am still underperforming both the FTSE 250 and S&P 500. However, I still think this is the short term. I've only been investing since the inception of the portfolio, or stock picking, since April 2020. It's not been a year yet, so it's understandable that I may be underperforming. And I think there's much valuable lessons as I can learn is important in the early stages whilst I don't have that much capital available to my name. So at the moment I remain calm. Sure, I've outperformed for this week, but then the 3 weeks prior I had underperformed. So we'll only see what happens with time, but hopefully eventually we do come onto a more consistent pace and start to outperform. But I'm actually very happy with this at the same time. The markets had dropped by quite a considerable amount and my portfolio had shown resilience. Sure, if you're looking to buy the dip, this isn't a good thing, but I have just finished building my emergency fund, or rebuilding it, since my graphics card blew up about a month ago now. And now I feel that I don't have any cash to buy the dips. And especially I realised on Thursday when we had that volatility that I didn't really have anything to put forward. So I'm going to talk more about that later, but I feel at the moment if my portfolio isn't dropping by that much on a weekly basis, that's good for me because I'm not actively looking for discounts. I'm just looking to slowly build equity and whilst I build up that cash position on the side. The top topics of the week actually start with Boohoo. On Sunday evening, following the portfolio update number 43. If you'd like to see that, I'll chuck a card at the top right of the video. That's last week's episode. Boohoo had been revealed, or the Financial Times had released an article stating that Boohoo were set to acquire Debenhams. Naturally, I commented this on my Twitter and got more than 20 likes, and I'm very proud of myself. Thank you. Bad humour aside, this was £55 million for the acquisition of Debenhams, only their brand and website. Initially, I had believed this was actually their stores as well, and I had a more negative opinion on it. However, since then, now that I know it's the brand and website, I think this is a very good move by Boohoo. This allows them to diversify their core market. Usually they target between 16 and 30-year-old women. Debenhams, I think, adds to the higher end of that, and I think that's a good category to be in. That allows them to become more diversified. Sure, it could lower their growth potential overall as a business, but I think this is a great, well-known brand to add to the collection. Furthermore, I think there's one thing that many investors have kind of not really taken in from this acquisition, and that's their exposure to the beauty sector. Debenhams had quite a big beauty department, and Boohoo had slowly been trying to move into this sector with Pretty Little Thing. If they used Debenhams to their advantage, they could add this to other of their brands, and they could really expand out into the beauty industry. And I think that's where a lot of potential lies. I've said this in the past before, but I think Boohoo has the potential to become more of a conglomerate as they expand and they own more brands in different niches occupying different fundamental uses. The idea of this is Amazon back in early 2000 was a book retailer. I strongly believe that Boohoo could slowly diversify and move out and become an e-commerce giant. And to see this happen in the UK markets is quite good to see from a more nationalistic side of things, as most businesses usually sell up to an American firm. I also believe that there is potential for an acquisition. At around a £4 billion valuation, that's not too much for an American firm to go, you know what, we'd like to purchase Boohoo. I do hope that it would get rejected by shareholders in the UK, but there's always that potential to certainly increase shareholder value. However, there was a backlash on the matter of Boohoo because, well, ultimately, sure, they could acquire Debenhams' brand and website, but this still means there's a lot of jobs that are going to be lost. And I feel that it's not really at fault of Boohoo. There's not too much they could have done about this, and they are an online-only business, and taking the high street stores on were a liability. But I understand where these people are coming from, but I think spinning it against Boohoo is kind of silly as they are trying to help Arcadia out. Well, I suppose they're not actively trying to help Arcadia, but they are buying from Arcadia, which is inadvertently helping them survive, which may mean they can fix their pension deficit, although I'm not entirely sure if Arcadia had a pension deficit. I'm just speculating. But what I do like is the ambition that Boohoo have shown, and this is an ambition that could give us a lot of growth potential. Furthermore, this goes on to the second topic of the week, which they are rumoured to be looking to buy 3 more of Arcadia's brands. These are, and I personally don't really know them too well, you've got Wallace, Burton and Dorothy Perkins. Whilst I know of them as a name, I don't think these are really I'm not part of the target audience of these brands, and so it's likely they are lesser known to me. However, to some consumers they could be a well-known brand, and seeing that they're looking to buy all 3 of them for around £25 million, I think this is a well-placed acquisition. Compared to the likes of ASOS, which is regarded as one of Boohoo's closer competitors even though they have different fundamental changes in their business model, ASOS seem to be looking to acquire Topshop for over 400 million. That's ridiculous. I don't think it's worth that, and they're putting all their eggs into one basket. I think I like the growth potential that Boohoo is offering here. They're buying the well-known brands, but they're buying smaller versions that could certainly grow a lot further than Topshop. And I think Topshop is quite overrated. I don't think there is too much of a brand loyalty in the clothing industry. I say that actually, and then loads of people wear logos all the time, so perhaps I don't fit in this category, but I am happy to purchase a quality product that fits well and, well, it is at a fair price. I'm not naturally just going to be biased to one brand because of that, and I would assume others would be like that, and that's why I believe Boohoo to be in an advantageous position. They offer cheaper goods for a cheaper price, which I think is a valuable trade-off for a generation of people that are deemed to be the most educated but also the most likely to financially struggle. Again, I'm speculating, but I'm sure I'd heard that in a recent article, and that really sets off a lot of people because, well, you can imagine that my sort of friendship group areas or like social medias are all tethered to this age group, and so I see it a lot, yet they're still sat there doing nothing about it. I'm just ranting, sorry. Regardless, I still hold 2,500 shares of Boohoo. I still think this is a strong buy, and yeah, I would love to buy more shares of Boohoo, but I need to be disciplined here, and I do not want to overexpose myself to Boohoo once more. Once I balance out the portfolio, then I will look to be adding up to my position in the future. I love the allocation I have already. I would like it to be dropped down to 30% so that my other positions can have a more fair share of the portfolio's returns, but I'm not against buying it again in the future. Boohoo was actually the top riser in the portfolio, although it was just the stock that decreased the less, and this was dropped by 0.91%. I suspect that the purchase of Debenhams had reduced the downside, as on Monday there was a high sentiment boost, but I also believe they are still very undervalued at this period in time, especially with the acquisitions they are making. The London Stock Exchange Group Refinitiv acquisition has been completed, and it's happened. You may have noticed that shares of London Stock Exchange have dropped by quite a considerable amount. Right now, London Stock Exchange is a £46 billion market cap from a £30 billion market cap. And honestly, I think I'm a bit disappointed, and I think I've made a valuable mistake. I'm glad that I've learned this one earlier. Usually I'm happy to pay more of a premium for a higher quality investment. London Stock Exchange is certainly a high quality investment, and no doubt it will do well in the future. However, I think speculation over the acquisition of Refinitiv had pushed the price up to a more unsustainable level, and this had meant whilst, yeah, you could buy it for this price and maybe it will hold its value, this could mean that it's priced in many years in the future, and therefore the growth potential is less in the next 5 years, for example. And they may still continue to grow their earnings at a strong rate, continue growing their dividend, but the massive concern is whether they will continue trading up on valuation multiples. And I don't think that's going to happen. And I suspect that investors of London Stock Exchange Group are going to realise that they had speculated more than its actual value, and it may start to decline. And that's why in the last week it has been the top faller, dropping by nearly 5% or 4.76%. I believe this is largely due to the 37% economic interest that Refinitiv now has in the business, or their owners, Thomas Reuters, and so that's likely certainly changed the pricing up. But I really did expect more from this, and I think I was a little bit more overhyped than I really should have been. And recently I had been talking about the idea of selling it, and I said that it holds its value well, I will look for another opportunity and I will sell. Well, it's not really held its value well. I'm still in the green. Sure, I could continue holding for another 6 months, But how do I know the share price is really going to go back up? Whilst yeah, it's a quality business, I think I'm likely going to sell my investment and place the money elsewhere when I find an adequate opportunity. I still believe it's a high quality investment, but I think I've bought at the wrong valuation and feel that it's more of a dividend investment in a time frame, or my own personal time frame, where I think I should be prioritizing more growth. Therefore, whilst I still hold 10 shares of London Stock Exchange, I'm likely going to slowly liquidate this position and invest elsewhere in stocks where I see higher growth potential. However, if you are invested in the London Stock Exchange Group, then I wish you the best, because I do believe it will continue to do well, especially with Refinitiv that will likely unlock their profit margins. But at a valuation of £46 billion, I think the upside potential, at least in the UK investing space, is a lot more limited. If this was invested in, or this was listed in the New York Stock Exchange, for example, in the US, then I think this would certainly reach much higher levels and could certainly be a giant of over 200 billion over a considerable period of time. But in the UK markets, I think that's just not going to happen. This week we had seen a fair pullback of over 3% on Friday, and I'd realised that I'd made a big mistake. This is because I had no cash on the sidelines. I wasn't ready for this dip, and I'd done my stock purchasing on the day before, which is really unfortunate. And it means I've missed out on buying some stocks at a better value than I had bought them, but at the end of the day, I am holding for the long term, and so a few percentage change isn't the biggest deal for me. But what it has taught me is that I should hold at least a small cash position on the sidelines, as at least I could get some value out of a dip, even if it's not too much or much in the sense of the size of the portfolio. Regardless, I did buy an additional share of Games Workshop, and this was partly rallied by my stock analysis that I had done last week on them. If you'd like to see that, I will plop the card at the top right of the video for later to watch. And Games Workshop is a stock I'm very bullish on, and they've weakened. They've been acting more like a US tech stock, and this really isn't how the company is, and I think that this sustained weakness isn't going to last too long unless investors become less bullish and it starts to trade down on valuation multiples, which is possible, but I don't believe this will happen. At a price to earnings ratio of 35 times, sure, it is on more of the premium side, but I certainly think it could go a lot higher. And therefore, I now hold 53 shares of Games Workshop in total and continue to average up. I'd also received a dividend income from Games Workshop, which would have been when I had around 50 shares, I believe, as the dividend income was exactly £30, which I had immediately reinvested into a combination of Games Workshop and the next stock. And if you're wondering which investment broker I'm using, I use the Freetrade UK app with my stocks and shares ISA, and if you'd like to sign up to this, I will leave a link in the description down below for you. It may come as little to no surprise to regular viewers of the channel, but I picked up an additional 21 shares of Team 17, bringing my total holding to 49 shares, as I want to build this to my third largest position in the portfolio. I'm very bullish on this company, and I believe I have some specialist knowledge on the industry. Sure, I'm not a developer, or I don't have the insight from an employee perspective, but I was a person in that retail community. I've owned I've owned quite a few of their different games and brands. I've grown up around the Worms franchise, and Golf with Your Friends, a recent acquisition they have made, which may have caused the share price to drop slightly, is one that I believe is an excellent buy, and that's not because of bias from playing the game, but rather because it's a well-known game in the community. And they had great results, but obviously because they had admitted that the pandemic had caused most of this, or trying to be more realistic, this had led to a decline in share price. As they build up their portfolio of indie game brands, I think they could build a very substantial moat and really be an industry leader, at least in the UK. It's likely I may start moving money out of London Stock Exchange into Team 17, where I see value, and if Team 17 continues to drop, then this is very likely to be the case. The share tip of the week isn't a stock, but rather my opinions and thoughts on a stock, which is GameStop and the whole Wall Street bet situation. I wanted to give my brief opinion on the matter, and hopefully a more unique perspective, as I'm not invested in the US markets, nor am I that interested in them. So someone from a UK investing standpoint that likely has no bias towards certain US companies, I think I can add that extra perspective. Firstly, it's worth noting that GME, or GameStop, was discovered by a Redditor, which is described as the front page of the internet, on a subreddit, which is a page of Reddit, by one called Wall Street Bets. Effectively, what they had noticed is that a hedge fund were shorting GameStop to the ground. And this is actually quite illegal, but they had found some loopholes to get around this. And so they put a lot of risk into this investment. A Redditor had noticed this, pointed it out to other retail investors in the community, and as a collaboration, they decided that it was worth pumping the stock up. What had happened then is a lot of retail interest had got into the stock, share price had gone up. As these hedge funds were de-risking, they had to therefore close their short positions, which required them to buy back up at a higher price, pushing the share price up to over $400 like we had seen. And whilst I think it's quite entertaining to watch and see and think about people that may have made this money, they've not made profits until they lock it in. And sure, I will admit it is pretty interesting to see billionaires getting very upset because retail investors one-up them. And I love the idea behind it because it's like we're giving it to the man, but at the same time there is so much risk involved for the retail investor. I don't think they even know what they're involved in. And this is due to a few reasons. Firstly, the quality of the investment. GameStop is no way a company I would ever invest in, or I say ever, unless they radically change things up. Their business model was pretty bad. They would always pay too little and sell things for too high. They were a low quality, and this is from my personal experience and the horror stories that I've heard online. They were apparently really toxic to their employees. And there's so many red flags in this investment, there's no real surprise why it was valued at such a low price originally before the run-up. Which means, in my opinion, this stock is of a lower quality and heavily overvalued, which is a combination of two things that I think don't mix very well. This could mean that the share price could fall massively at any point, but I'm sure many people are aware of that. But this comes more especially to those that are betting their life savings on GameStop. I know this because I have friends that have never even considered investing before in their lives suddenly talk about GameStop and how they've bought shares. This is concerning. This gives me a feeling that we are entering bubble territory in certain US stocks. And this has been happening for a while, and with the Fed currently expanding their balance sheet, I think it's going to keep going up and the bubble will continue rising, but I do think it will eventually pop. I believe right now you need to calibrate your risk. Will you lose sleep if you lose 50% of your portfolio? If so, I would certainly really reconsider your position size with GameStop. Furthermore, there was a story, and I believe it was about JFK's father, but I may be incorrect as this is off the top of my head. The idea was that he was talking to a street urchin. I'm not sure why, I'm guessing it was a casual conversation. But the idea was that this street urchin, this little boy, was talking about stocks. And this had come to the mind of JFK's father because he believed that why was he talking about stocks? What did he know about them? And why was he recommending stock picks? Which gave him the idea that it's a little bit too popular and people are making easy money. At that point, he famously sold out prior to the 1929 Great Depression. Whilst I'm not saying, right, that's it, it's the end of the market, bubble's going to pop, go all cash, I'm not saying that. I do think there is an element of risk involved, and I believe certain US industries are heavily in bubble territory, and there is a lot of people that are chasing games without looking at the fundamental values of the company, but saying it's all about the story. Sure, a story is good and speculation can help boost a share price, but when they have absolutely no fundamentals to back it up, that is a huge red flag in my opinion. Good luck to those invested in GameStop, and I hope that you do manage to cash out before it comes crashing down, but I don't think this is going to happen. And whilst sure, the retail investors are certainly beating the hedge funds for now, I don't think this would last. Furthermore, we also have brokers that have been suspending trading. I think there's something a little bit dodgy about that, but also don't forget they are liable and they need to de-risk for their investors. And so in the UK, it does make sense to me as to why specific brokers have sent out multiple warnings and also limited the trading. But then if they're limiting the buying of it and you're only allowed to sell, that seems a bit suspicious in my opinion. I personally will be building a cash position on the side. I think this is very valuable, and especially with the US markets, I would highly believe that if I was invested in the US markets, I would definitely be really looking to build up that cash position, or maybe trimming positions to build it up. As they say, when the US sneezes, the whole world catches a cold. And so whilst I think the UK markets are very resilient, if there's a pop in the US of any kind, I do think it will hit across other markets. If you're interested in my Games Workshop stock analysis, then click the card at the top right of the video. Thank you for watching. Have a fantastic Sunday afternoon.